All right, hello everybody. And today's lesson, what we are going to talk about are calendar spreads and how they can work out so well. We've had a few of them here at Prosper in the last couple days that have just been fantastic signals. First one we're going to talk about is Lululemon. We had going into earnings. We had the 115 calendar call spread. So earnings were last Friday morning. We were short last week's 115 call and long this week's 115 call. And we did that initially for a price of 58 cents. And the reason we had chosen the 115 call is because prior to earnings, I'm going to pull up this chart right here. And we can see it right here. Sorry about that. Prior to earnings, stock was trading right here, right around 105, 105 and a half. Obviously, you can see this big gap here. And what happened was the expected move was about $10 in Lululemon. So we liked the upside. We liked all the technicals to the upside. So by trading and by putting out a signal on the 115 calendar call spread, what that does is gives us upside exposure to an upward move and also allows us to take advantage of the big implied volatility difference between what we sold that expired last week and the long call for this week. So we had bought that spread at 58 cents when the stock was trading 106. We exited right after the move, right after earnings came out. When the stock was trading about 116, we actually sold that spread for $1.40. So literally in about 2 market hours, we made 140%. Now let's look at another one here. Target. Okay, we had a Target calendar spread back from when they reported earnings back on May 25th. So at that point, the stock was trading 72.80. Right in here. Actually, that's where we were the other day. Right May 15th, we put that on. So here we go, right here. Expected move at that point was about $5 going out to regular June expiration. So what we did is we sold the following week, so the week of earnings right here. We sold the 77.5 call, bought this June 15th expiring 77.5 call. So again, we did that. We liked the upside in Target. We liked the technicals behind it. We wanted exposure to the upside. We also wanted to take advantage of the massive implied volatility and premium difference between the May 25th option and the June 15th option. We were able to buy that spread for 45 cents. We exited today for 80 cents. Bought it at 45, sold it at 80, 77.8% profit. A lot of that is due to the upside move. A lot of it is also due to the big difference in implied volatility. Last one I want to review real quickly, NTAP. Okay, NTAP, back on the 23rd of May, we actually traded 2 calendar spreads going into earnings. So you can see earnings right here, the 23rd of May. And we traded 2 calendar spreads. We traded both a call spread and a put spread because when we were right here, okay, right here going into earnings, we weren't real positive directionally. Did not have a good feel whether this thing was bullish, bearish. But what we wanted to do was take advantage of, again, the massive implied volatility discrepancy between the earnings week options, which were the options expiring on May 25th, and then options expiring actually this week. So what we did is we did 2 calendar spreads, a calendar put spread, a calendar call spread, called a strangle swap. And what is ideal in a strangle swap is you want the stock to move to one of the 2 strikes. So in our instance, we had the 62.5 put to the downside and the 77 call to the upside. So essentially we were playing both sides of the market. We just did not want the stock to stand still. We wanted it to move. Okay, so we bought that for 85 cents. Never had a chance to get out until today. Big move in the stock today. Stock is now trading, as you can see here in a moment, all the way up at 71.27. So as of right now, we still have not exited. Our calls are trading right here, about 90, 95 cents. Okay, so we have not exited yet, but we do have a stop exit order in. For risk management purpose, we have a stop exit order in right at our entry price of 85 cents. So we cannot lose on this trade. That is all part of risk management. If we continue to get a bigger bullish move to the upside, and there's been a lot of volume behind this thing here, we'll just keep raising the stop and raising the stop to make sure that we lock in profits, all the while hopefully appreciating our 71 call, which expires this week. All right, so little background on calendar spreads and how they can be effective, when they're effective, when you try and take advantage of them. Have a great evening, everybody. And I have to tell you that stock and stock option trading involves a substantial degree of risk, may not be suitable for all investors. Past performance not necessarily indicative of future results. All right, everybody, we'll see you in the trading room tomorrow. Take care.